What's up, guys? We're going to be talking all about how to calculate how much cash you should have on the sideline. Do you have too much cash on the sideline? Do you not have enough cash? After you watch today's video, this should hopefully help you determine if you are holding too much cash, because the reality is holding too much cash on the sideline can be a long-term drag on your portfolio, and I'm sure you do not want that. So stick around, we're going to break it all down. Welcome back, guys. If you like today's content, be sure to hit that like and subscribe button so you can keep getting content just like this. And of course, if you need help with your own finances, reach out to us at www.modernwealth.com. That's modern spelled with no vowels, wealth.com. So it is incredibly common for a new client to come to Modern Wealth and they show us their balance sheet and we find that they are just hoarding a ton of cash on the sideline and actually have far too much cash on the side. And it's to the point where it's probably dragging down the long-term success of their portfolio. This has been made worse by the fact that interest rates on high yield savings accounts, money market funds, things like that have gone up quite significantly, that a lot of people are finding a lot of comfort and are getting a little bit too cozy with the idea of having a lot of cash on the sideline in their portfolio. But this is really nothing new, right? Investors, I have found, have always been like this, right? People tend to have too much cash in their portfolio, or their overall cash management strategy is not that optimal. So what we're going to be breaking down today is how to calculate how much cash you should have on the sideline so that you don't inadvertently hold too much and drag down the return of your portfolio. So step number one is to calculate your 3 to 6 month cash reserve. So this is really straightforward. You're simply just going to take whatever your monthly burn rate is and see what you spend on things like food, your mortgage, your rent, right? All those expenses that you have on a monthly basis. You're going to see whatever that is, and you're simply going to multiply that number by at least 3, right? So if your burn rate is $10,000 a month, take that number, multiply it by 3, and voila, there is your 3-month cash reserve in this example. Depending on your comfort level, you might want to dial it up all the way up to a 6-month cash reserve. This calculation for a 3 to 6 month cash reserve works for, I would say, the majority of investors, but there are a couple exceptions to it. The first big exception are folks in retirement. If you are in retirement and actively drawing down from your portfolio, it could be completely reasonable for you to hold, let's say, a 12-month or even a 24-month cash reserve in some cases on the sideline in your portfolio, because you're actively drawing down your portfolio to live in retirement. Another exception could be a business owner, right? Depending on the type of business that you run, it could be completely reasonable for you to have, let's say, a 9 or 12-month cash reserve on the sideline rather than your typical 3 to 6 month cash reserve. And then finally, the other kind of exception to this are folks with rental properties. If you are someone with, let's say, multiple rental units, and you need to account for the fact that, if something blows out on one of those rental units and you need to replace it, right? That's inevitably going to be a big cost that you need to account for, but you don't know when that is going to happen. So baking in a little bit of extra cash to account for those unexpected expenses associated with your rental properties is not a bad idea. So for example, a 12-month cash reserve in this scenario could completely make sense. So once you have determined what your just baseline cash reserve should be, now we need to add a couple of things to it. So the first thing we're going to add is you need to add in your deductibles, right? So health insurance deductibles, auto insurance deductibles, right? Whatever those are, I need you to add that in to that number that you just built out, okay? So add that to the number. Next, we need to account for taxes. So if you're someone who does quarterly tax payments, or you're someone who is going to file and you have a big tax liability that's coming up, that needs to be accounted for. So whatever projected tax bills or tax liabilities that you have coming up, that needs to be factored into the equation as well. Finally, once we've accounted for all of that, whatever short-term goals you have in mind need to be baked in as well. So let's just say very simply, you have a big vacation that's coming up and that's going to cost you $10,000. If that's the case, add $10,000 into your overall cash reserve. Now, if you've been tracking along and you've been adding how much cash you should have, right? You've gone through this entire formula, whatever number you've come up with, that should be a sufficient cash reserve for your situation. Now, if you are someone who is holding a lot more cash than whatever number you've just calculated, then you are very likely sitting on too much cash. Now, you're probably thinking, a lot of people probably think, well, I want to hold extra cash because I don't know what's going to happen with the stock market, right? The stock market might fall and I don't want to be overly exposed to risk with the extra cash. This is a common concern that a lot of people have. And what I find is that investors tend to view investing as very black and white. It's either I'm all in stocks or I'm all in cash. Very common scenario are folks who are, let's say, in their career years, in their 30s and 40s, in their retirement accounts, they're invested all in stocks. And then in their non-retirement accounts, it's a disaster. It's like excessively in cash. They have no idea what to do because they don't know how to design a portfolio that isn't geared towards retirement 20 years out. So if that's you, you can incorporate different asset classes that maybe don't have the same risk profile as stocks, but aren't as conservative as cash. Great example of that is good old-fashioned core bonds, right? Fixed income, right? Bonds historically have generated a higher return than cash and yet have a much more conservative risk profile than someone who's investing in 100% stocks, right? That could maybe be a happy medium. This is why people have 60-40 portfolios with 60% stock, 40% bonds, right? To have that happy medium with risk. You don't hear about people having a 60-40, 60% stock, 40% cash portfolio because cash historically has not had that great of returns. So if you are holding too much cash, think about different asset allocations that you can incorporate to balance out risk a little bit. Again, investing doesn't have to be black and white, all in stocks or all in cash. Now, if you went through this calculation and you actually don't have enough cash, the opposite, then a couple things I want you to keep in mind. Number one, that should be priority number one for you. If you are working, you're actively saving, you should focus on building up that cash reserve. If you're someone who is trying to max out your 401k and are pedal to the metal in retirement savings, I would think about dialing that back a little bit and focusing on building up that cash reserve first before we continue focusing on those areas. Again, having a sufficient cash reserve is designed to protect you when the unexpected happens. And that should absolutely be a priority for you before saving for other goals. If you are someone who has, let's say, equities or investable assets in non-retirement accounts that aren't in cash, right? Maybe you're someone, great example, you have a bunch of RSUs that have vested and you could easily sell those with minimal tax implication. Well, perhaps consider maybe trimming some of those or some of the equity in your portfolio to raise your cash to a sufficient cash reserve level. So bottom line, guys, cash is incredibly important. We want to ensure that we have sufficient cash in the portfolio. We want to make sure that we account for the unexpected, but at the same time, we don't want to overdo it or underdo it either, right? We want to find that happy medium with cash. And I think going through those steps that we outlined today should hopefully help out. If you need help with your own financial plan after watching today's video, feel free to reach out to us at www.modernwealth.com. That's modern spelled with no vowels, wealth.com. sideline.com. It's been a ton of fun, guys, and I'll see you next time.